If you don't feel like you're ever going to be able to buy a home, you're not alone. With the cost of homeownership at an all-time high, there will be many people who will be forced to rent forever. This means these people will never realize the benefit of paying a mortgage down, take part in property appreciation, or enjoy a relatively stable cost of housing. Gone are the days of being able to buy a substantial home in the suburbs, raise a family on a single income, and retire with a large pension. Individuals today need to work hard if they want to achieve the goal of homeownership. Take a look at some of the main factors making it seemingly impossible for first-time homebuyers to achieve the dream of buying their first place. Help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. The average home price in 2023 is roughly $437,000, according to the Federal Reserve Bank of St. Louis. This might seem incredibly high, but home prices are actually down significantly from recent all-time highs in many regions. Prices nationwide have dropped almost 10% from late 2022, saving homebuyers quite a bit of money when it comes to purchase price. Data shows that western states like Nevada, Arizona, and California have seen prices decline, and large cities nationwide have seen the largest price decreases, like Phoenix, Portland, Las Vegas, Seattle, and San Francisco. They haven't come down everywhere, so not all regions have seen a relief in ever-rising prices. That's quite the jump from when your parents and grandparents were buying their homes decades ago. For comparison, the average home price in 1980 was about $64,000. It is worth mentioning that average home appreciation hasn't been completely out of control when adjusted for inflation. Long-term inflation rates are actually not too far off from nationwide real estate prices. Prices have cooled off in many major markets across the country, mainly due to rising interest rates, but these higher interest rates make mortgage payments much higher than before. Those that were celebrating the rate increases as they hoped for prices to drop so they could finally afford a house are in for a rude awakening. Come to find out, you might actually be better off paying a higher price with a lower interest rate mortgage than getting a better price on the house but with a higher interest rate. Take a look at some rough numbers to see how interest rates will influence a typical mortgage payment. If you were to take out a 30-year mortgage for $400,000 at 4% interest, the monthly payment would be $1,910 per month. This only includes principal and interest. Now, if you were to borrow the exact same amount of money for the exact same amount of time at 6.5% interest, the monthly payment would be $2,528, a difference of over $600, which is comparable to borrowing an additional $100,000. It's one thing to be able to swing the mortgage payment on a home, but it's another to be able to afford the other costs of homeownership. The average property tax rate in the United States is about 1%, so on a $400,000 property, you're looking at $4,000 per year in property tax alone. What do you think the chances are of those going down? Insurance is another large cost that you'll incur as a homeowner. NerdWallet found that the average homeowner's insurance rate is about $1,800 per year. In addition to property taxes and insurance, you need to consider how much utilities are going to run each month. Heating, cooling, electricity, and internet add up quickly. Furthermore, maintenance, repairs, and updates are commonly underestimated. Budgeting for a new roof, water heater, furnace, and appliances is critical because these items, in addition to others, have a useful life. If you're not accounting for these expenses before buying a home, you're setting yourself up for failure. What happens if you can't pay to heat, cool, and maintain your home? With interest rates having risen, so has the percentage of homebuyers paying cash. Money.com says that last year, 36% of all single-family homes and condos were purchased with cash. During recent years, many homebuyers were choosing to finance their home because the cost of borrowing was so low. Even though buyers had the money available, they didn't want to pay cash when they could get a 30-year fixed mortgage at 3% or 4% and put those funds in a better place. However, rising amounts of cash buyers continue to make it difficult for those who are getting a mortgage to compete in the market. Understandably, home sellers prefer cash buyers because the transaction isn't dependent on the bank to fund the loan, which is never guaranteed until closing day. Cash buyers often waive an appraisal, meaning the sale isn't contingent on the valuation from a licensed appraiser either. Cash buyers also have the ability to be more competitive in that they can pay more for the property simply because they are wealthier and are less affected by the price paid for the home. Even though interest rates are historically very low, the recent spike in mortgage rates is trapping people in their current homes. These homeowners might never be able to afford to buy a different home. Selling and buying a new home will mean a new mortgage and a new mortgage rate much higher than those record lows. If you have a record low mortgage rate, you're not going to want to sell and give that up. Taking out a mortgage at current interest rates, even for the same amount of money, will result in hundreds of extra dollars each month, and this is money out the window with no benefit to you. And if these people are going to move to a new home, they're looking at significant price increases. This might cause homeowners with record low interest rates to remain in their current home for quite some time. With the average new car payment of $716 per month and the average used car payment of $578 per month, according to LendingTree, it's not surprising that many people can't afford to buy a home. In order to qualify for a mortgage, you need to show financial stability, and if your debt levels are too high compared to your income, lenders won't even consider lending to you. In addition to being able to borrow the money for a home, you need to be able to repay the money and carry all other bills associated with homeownership. Something breaks in your house? That's extra money you need to come up with. Cost of heating fuel skyrockets? Hopefully you have a contingency in your budget. The long list of expenses that come with being a homeowner can be extremely difficult to handle when you're paying $1,000 for a car every month. And if you're a household with 2 new cars, you could be spending $2,000 or more just on cars. Not to mention student loans and any other debt you're juggling. With more and more people working from home, these numbers should be going down. Almost as crippling as astronomical car payments are student loans. With many young adults carrying hefty student debt, this can make just getting by on a monthly basis more difficult, never mind buying and maintaining a home. Ramsey Solutions found that the average student loan debt per borrower as of 2021 was nearly $40,000. This type of debt prevents young adults from making basic financial and life decisions. For example, 40% of them say their student loans prevent them from investing for retirement, and 47% put off buying a home. By the time their loans have finally been repaid, will they even be able to afford a home? Prices have certainly skyrocketed since the last generation, but home sizes have also been on the rise, bringing a little bit of sense to these rising prices. In 1980, the average new home was just under 1,600 square feet. Today, the average new home size is closer to 2,400 square feet, despite the size of the average household decreasing. Working from home might save on the cost of commuting, but what isn't spent on gas and cars now seems to be spent on larger homes. Many households that have 2 people working from home might need their separate office spaces where they can get work done and attend meetings without being distracted by others. More time being spent at home also means more living space needed. It's not like it used to be where 1 bathroom, a small living area, and a small bedroom were all that was desired. People understandably want more space. They want more bathrooms, offices, additional living spaces, and larger kitchens where most of their meals will be prepared. They want more room to get away from their spouse. Compare this to just a few years ago when most people worked outside of the home and the home was seen primarily as a place to rest their head. With high levels of debt and astronomically high home prices, the size of the down payment can make a big difference in your monthly mortgage cost. There are many programs that offer first-time homebuyers the ability to put very little down in terms of the down payment, which sounds great until you see the difference in the monthly payment. A 3% down payment is often all that's required, but this will increase your mortgage payment quite a bit when compared to putting 10% or 20% down. The principal and interest payment on a $400,000 mortgage is $2,528 per month, compared to a $320,000 mortgage, which is $2,023 per month. In addition, buying a home with less than 20% down will usually require private mortgage insurance, or PMI. The cost of private mortgage insurance varies, but you could expect to pay about 1% of the total mortgage amount each year for this. On a $400,000 mortgage, This will run you about $4,000 per year, or $333 per month. Suddenly, the option to put less of a chunk down on a home is costing you an additional $800 per month. The question is, how are you going to pay off other debt and save 20% for a down payment while continuing to pay your rent? Buying a house is becoming less and less affordable, and it seems the odds are stacked against first-time homebuyers. Unless you already own some real estate, it's difficult to buy. Between astronomical home prices, interest rates that have recently shot up, rising taxes, insurance, cost of maintenance and utilities, you really need to be strategic about this. If you're looking to buy a home in the future, take a careful look at what you can do to make the process more affordable. You might be surprised at how much of a difference they can make.